Hello to all my seniors and friends. I am CA Gaurav Garg and welcome to my podcast. You are tuned into my YouTube channel where we simplify complex legal and tax matters for professionals and business owners. Today we are diving into an important Delhi High Court judgment in the case of a Travelport International Operations Ltd versus DCIT. This ruling holds significant implications for businesses with permanent establishment in India, particularly concerning withholding tax calculations.
Hi Gaurav, this is CA Preksha Gupta. Hi Gaurav, this is CA Preksha Gupta. So let's start with the ruling. So my first question is, so what was the central issue in the case before the Delhi High Court?
Thanks, Preksha. The main issue resolved around the rate of withholding tax proposed by the assessing officer under Section 197 of the Income Tax Act. The AO recommended a 6% TDS or withholding tax rate for Travelport International, but the calculation was done incorrectly. It was based on percentage of the gross revenue attributed to the company's permanent establishment in India without accounting for any deductible expenses.
Got it. And how exactly did the AU arrive at the 6% withholding tax rate? Also, why was this approach considered flawed by the court?
So here what happened, Preksha, the AO determined that 15% of Travelport's total receipt could be attributed to its P in India. Then they applied a 40% tax rate on this portion of the gross revenue, resulting in the 6% withholding tax rate. The issue here was that AO calculated tax liability on the gross revenue, entirely ignoring the expenses incurred by Travelport in generating that revenue. As we all know, as we all know, income tax is levied on net income, that is revenue minus expenses, not on gross receipt. The AO's approach of taxing gross revenue without deduction was fundamentally flawed.
That's a critical oversight. So, how did the Delhi High Court respond to this issue?
The Delhi High Court didn't agree with the AO's method. It set aside both the AO's order and the tax certificate issued under Section 197 of the Act, citing the failure to consider Travelport's expense. The court underscored the principle that income tax should be levied on net income, not gross receipts. Accordingly, the case was remanded back to the AO with the clear instructions to reconsider Travelport's application for a withholding tax certificate, ensuring that the expenses were factored in when determining the withholding tax rate. Moreover, the court requested the AO to expedite the process and issue a fresh decision within 4 weeks.
That's a fair decision, considering the AO's initial approach didn't align with basic tax principles. Thank you, Gaurav, for breaking down the judgment so clearly.
It was my pleasure, Preksha. Cases like this one are important because they clarify the aspect of taxation law and help businesses understand how tax regulation should be applied correctly.
Absolutely. And before we wrap up, we want to thank all our viewers for tuning in. Don't forget to like this video, share it with your friends and team, and subscribe to the channel for more insightful discussions on tax and legal updates.
Yes, and if you have any questions or want us to cover any specific topic in our future videos, feel free to drop your suggestions in the comment. Until next time, take care and stay informed.